Most people who click on a video like this already think they know the answer, and that assumption is costing them hundreds of thousands of dollars. Here's what nobody actually explains. Whether buying or renting wins for you has almost nothing to do with the housing market, and almost everything to do with one specific number most people have never calculated. We're going to get to that number, and when we do, it's going to completely change how you look at this decision. I've spent a serious amount of time going through the actual financial models on this, pulling from real data and running the math across a full 30-year timeline. And what I found is that both sides of this debate are right, and both sides are wrong, depending on a few variables that most people skip right over. So I'm going to walk you through the real math, show you two guys who make the exact same money and start with the exact same savings, and watch what happens to their net worth over 30 years. The answer at the end is not what you'd expect. Let's start with the thing that's probably brought you here in the first place, the guilt. That feeling that renting is just throwing money away. Someone in your life has definitely said it. Maybe you've said it yourself. The idea is that if you're renting, you're paying someone else's mortgage instead of building your own equity, and that makes you financially irresponsible. That guilt has pushed millions of people into buying homes they weren't ready for, in markets that didn't make sense, at rates that didn't work. And right now, with the 30-year fixed mortgage rate sitting at around 6.65%, that panic buying instinct is more dangerous than ever. So let's actually look at the numbers. Meet Jake and Marcus, both 32, both earning $80,000 a year. Both have exactly $70,000 saved. They live in the same city, they want the same type of place, a comfortable 3-bedroom home. Same starting line, completely different decisions. Marcus takes his $70,000, puts it down on a $350,000 house, and locks into a 30-year fixed mortgage. Jake keeps renting a nearly identical home for $2,000 a month. But here's the part that actually matters. Jake doesn't just spend his savings on vacations. He invests his $70,000 into a total stock market index fund, and every single month, he takes whatever gap exists between his rent and what Marcus is paying in total housing costs, and he drops that difference into the market too. Now look at what happens in month 1, because this is where the myth completely falls apart. In that very first mortgage payment at today's rates, a massive chunk of Marcus's money goes straight to the bank as interest. Another significant slice disappears into property taxes, insurance, and maintenance. Only a tiny fraction actually reduces what he owes on the house. So on day 1, Marcus is losing far more capital than Jake is. And those costs, the interest, the taxes, the insurance, the maintenance, we call those unrecoverable costs. You will never see that money again. Property taxes are essentially a permanent rent you pay to the government forever. And maintenance? That will realistically run you 1 to 2% of your home's value every single year, just keeping the place functional. From a pure math standpoint, those costs are identical to what people call throwing money away on rent. Meanwhile, Jake's $70,000 is sitting in the market, compounding. Historically, the S&P 500 has returned somewhere in the range of 8 to 10% annually over long periods. His money doubles roughly every 7 years, and when his dishwasher breaks, he calls his landlord. He doesn't spend a Saturday at the hardware store. So at this point, you might be thinking Jake is clearly winning, and for a while he is. But here's the thing that changes everything, and it's the reason I told you the answer at the end would surprise you. Hold on to that, because we're not there yet. There's one more trap that almost nobody talks about before we get to the long game: transaction drag. If Marcus needs to move in 3 years because he got a better job offer in another city, he is in serious trouble. Closing costs, title insurance, and real estate agent commissions can eat up a full 10% of the home's value when you buy and sell. Whatever small amount of equity he's built in 3 years gets completely wiped out. Below 3 years, renting almost always wins because you simply don't have the time to recoup closing costs and transaction fees. Buying essentially locks you in place, and in a job market where mobility is one of your biggest financial assets, that lock-in has a real price. So how long do you actually need to stay for buying to make sense? According to Zillow's research, a buyer purchasing the typical U.S. home comes out ahead after about 5.9 years with 5% down and 6.0 years with 20% down. In most markets in 2026, you need to stay at least 5 to 7 years for buying to financially outperform renting. And in high-cost markets with high price-to-rent ratios, that break-even horizon can extend upwards of a decade. And it's not the same everywhere. Among the 50 largest metros, Columbus, Memphis, and Buffalo are among the fastest places to reach that break-even point, arriving in roughly 3.5 to 4.2 years. At the other end of the spectrum, San Francisco, San Jose, and New Orleans are markets where today's prices and rents leave renting ahead even over a full 30-year horizon. This is where that number I mentioned at the beginning comes in, the one that most people skip. It's called the price-to-rent ratio, and it's the single best cheat code for figuring out which side of this decision you're actually on. The math is simple. Take the purchase price of a home, divide it by the annual cost to rent a similar property, and that number tells you everything. Conventionally, a ratio above 20 signals that renting is the smarter financial move, and a ratio above 25 indicates a strong renter's market, where buying is especially hard to justify on cost alone. Right now, buying is cheaper in 23 of the 50 largest U.S. metros, while renting costs less in 27, showing just how much location drives this decision. So pull up Zillow, find a home you'd buy, find a similar rental, do the quick division. That one number will tell you more than any financial advisor conversation you've ever had. All right, if this is clicking for you and you want to go deeper on building wealth through investing the difference, I've got a video on index fund investing for beginners that pairs perfectly with this one. Check it out after this. And if you're finding this useful, hit subscribe, because this is exactly the kind of math we break down every week. Drop a comment below too. I want to know, are you team rent or team buy right now, and what city are you in? That context matters a lot, and I read every single one. Now, back to Jake and Marcus. Let's fast forward and see how this actually plays out. By year 10, Jake's liquid wealth has pulled ahead. He's sitting on a strong position in index funds, and his portfolio is compounding steadily. But here's the catch. Rent doesn't stay flat. It creeps up roughly 3 to 4% every year, which means Jake's monthly housing costs have been rising the entire time. Marcus's mortgage payment, on the other hand, is fixed. That payment that felt heavy in year 1? A decade of inflation has made it feel almost normal. By year 20, the race is incredibly close. Jake is slightly ahead in liquid assets. Marcus has built substantial equity. But Jake's rent has now climbed well past $3,600 a month, and that gap between his costs and Marcus's costs has basically disappeared. Then you hit year 30, and everything flips. Marcus's mortgage is paid off. He now owns a home outright and only needs to cover taxes and maintenance, maybe around $1,000 a month total. Jake, on the other hand, is paying somewhere around $5,000 a month in rent, with no end in sight and no floor under his cost of living. Marcus wins the net worth race, and it comes down to 3 things: leverage, forced savings, and inflation protection. His initial $70,000 earned appreciation on a $350,000 asset, not just the down payment. The mortgage acted like a savings account he couldn't raid, and his fixed payment meant inflation worked in his favor over time, not against him. But here's the twist that makes this whole thing complicated. Homeownership was the more profitable choice in all 250 cities analyzed in a recent 10-year wealth study, when assuming a renter reinvested a potential down payment in stocks. The operative word there is assuming, because every model that shows the renter winning assumes perfect, robotic financial discipline. Jake invests every single dollar of the difference, every single month, for 30 straight years, without ever touching it. That's not most people. If Jake spends that extra money on a nicer car, a bigger vacation, or just lifestyle creep, Marcus beats him every time. The forced structure of a mortgage is actually a feature, not a bug, for people who struggle with that kind of discipline. So here's the real truth that nobody tells you. This decision is not purely a math problem. The math is actually the easy part. The harder question is a behavioral one. Do you have the genuine discipline to be Jake, investing the difference consistently for decades without touching it? Or do you realistically need the forced structure that a mortgage provides? Your honest answer to that question matters more than mortgage rates, more than home prices, and more than anything else in this video. The right move is not the same for everyone, and anyone who tells you otherwise is selling something. Run your local price-to-rent ratio, know your timeline, and be brutally honest about your own financial behavior. Those three things together will give you a better answer than any blanket rule ever could. If you want to see exactly how to calculate your own price-to-rent ratio and figure out what it means for your specific city, that's the next video. It's right there. Go watch it. And if you haven't subscribed yet, now's the time. This stuff compounds, just like the money we're talking about.